Hello everyone and welcome to another exciting video lecture brought to you by the Academy of Financial Markets. I'm Michael Harding, your Chief Trading Instructor. In this lecture, I'll explain volume, lot sizes, margin, and leverage. Now, the first thing, you're probably noticing that I'm holding on to a few positions and they're in profit right now. And those are some trades that I made just before going to bed last night. So right now, we're looking at about a $603 gain. And in comparison to my account, that's pretty good because my account is only just over 5,000. So basically, I turned over about 10% while I was sleeping. And for most investors out there, if they make 10% in 12 months, they would be fairly happy with that. But I just made 10% in 12 hours. Now, a lot of you are probably wondering how exactly did I do that? And I was able to do that with what's called leverage. Now, most brokers offer leverage. Some of them offer a lot more than others. Some of them offer 50 to 1. So 50 to 1 means for every dollar that I put in, they'll match it 50 times. And there are some brokers out there that will offer anywhere up to 1,000 to 1. Okay, I don't recommend going with those brokers. You don't need anything more than 200 to 1. And in fact, even 50 to 1 is great. Now let me explain a little bit more what leverage is. When it comes to trading, you need to enter a volume, the lot sizes. So when you place a new order and the volume is 1.00, that's equivalent to $100,000. Now, we obviously don't have $100,000 to trade here, and that's where the leverage comes in. Okay, so if I wanted to trade $100,000 with leverage of 50 to 1, I would need $2,000 in my account. Now, if I had leverage of 200 to 1 and I wanted to trade 100,000, all I would need is $500. And when you trade $100,000, every pip is worth 10 bucks. And when you trade $10,000, every pip is worth $1. Okay, so you guys can go ahead and pause the video and just remember this. Okay? And I'll just explain a little bit further what I mean by this. So here, when I enter 1.00 in the volume, that means I'm looking to trade $100,000. And so with $100,000, every one pip the pair moves, it's equal to $10. So for example, if we take a look at Aussie USD on a 1 hour, and you can see exactly where I entered the trade, where I entered, I sold 200,000, so I sold 2 standard lots. And I'll just go down to a 1 minute so you can see. So right now the price is 75,097. The last decimal place is sort of it's a fraction of a pip. Okay, or it's like a pipette. Okay. So the last decimal place is not a pip. So but when it goes from 0.7509 to 0.7510, and in this case it's 0.7511, that's equal to $20. With this trade here, because the volume is 2.00, every pip is equal to $20. So you can see on the profit here that right now the price is 0.7508, and once this moves, just watch the profits down below. So 0.7508. Okay, we're not getting much action this morning. I do apologize. There we go. So you guys can see that, you know, my profit went up quite a bit within. This is on a 1 minute chart. Okay, and I'm making profit as this pair continues to sell off. And that's because if I just go back to the 1 hour chart, I sold $200,000. Okay. Now let me explain margin, and I'll just pull up the diagram again. So if I wanted to trade $100,000 with 200 to 1 leverage, I would need $500. And to see with this account here that I'm trading, it is a 200 to 1 leverage account. So down below you can see that I'm actually trading 400,000. So here's 100,000, another 100,000, and then a 200,000. So I'm trading 400,000. And my margin is just under 4,000. Sorry, so I'm actually trading 100 to 1. So the leverage on this account is 100 to 1 because the margin is almost 4,000. And so each of these trades, so this one was about 100. This one required $1,000 because it's 100 to 1. Again, I'll pull up the diagram so you can see. So 50 to 1, I would need 2,000. On a 100 to 1, which is what my account is, I would only need 1,000. Okay, for a $100,000 position. Okay, so I can't keep trading as many $100,000 positions as I like because this is my free margin here. This is the amount of margin that I have available to continue to play with. So I'll just give you an example here. If I wanted to, say I wanted to buy USD CAD, just go to new order, make sure USD CAD is selected in the symbols list, and so I want to trade 100,000, and just watch my free margin below. So I'll buy this, and you see it just required $1,000 from my account. So it didn't cost 1,000. It just placed that 1,000 in the margin category. So now my free margin is only 800 and so on. Now, depending on the broker, if your free margin starts to fall below 0, that's what's called margin call. And if you ever enter a margin call, the broker has the right to automatically close all of your positions without your permission. So that sums up for this lecture. If anyone is interested in viewing that leverage diagram, I've inserted it in the external resources section in the lecture. So now just before I go, I'm just going to close these positions. Lock in some profit. And so now you see we have $5,577, and this account was just at 5,000 just within the last 16 hours ago.